Riders. Living benefit riders give policy owners a way to use their life insurance to help cover the costs of terminal illnesses and long-term care. All permanent life insurance policies have so-called living benefits, referring to a policy owner's right to borrow or withdraw money from the policy's cash value. Living benefit riders take it a step further. They permit the release of some of the policy's death benefit to help pay for care, in amounts far greater than the policy's cash value, while the insured is alive. There are two types of living benefit riders. Accelerated benefits rider, or provision. Long-term care rider. Accelerated benefits riders. At one time, insureds suffering a terminal illness could access money from their life insurance policy only through a cash value loan, withdrawal, or policy surrender. These options involve loan interest and surrender charges that diminish the net amount and are usually insufficient in meeting the insured's needs. Accelerated benefits riders were created to address these needs. Originally available only through a rider, accelerated benefits are now available either through a rider or as a standard provision in the policy. In either case, the benefit is generally provided at no charge. An accelerated benefits rider, or provision, if built into the policy, allows a payout of some portion of the policy's death benefit while the insured is still living. The typical provision allows up to 50% of the death benefit to be available, though some policies allow more. Though intended to help cover living and medical care expenses, these funds can be used for any purpose. Qualifying for accelerated benefits. To qualify for accelerated benefits, an insured must prove that he or she has a terminal illness or catastrophic injury that results in permanent disability requiring long-term care. To be classified as terminally ill, the person must be certified by a doctor as having a condition that can be expected to result in death within 24 months. Once certified as terminally ill or critically injured, the insured may be permitted to choose whether he or she wants to receive the payout as either a lump sum, monthly payments over a set time period. No special exclusions and restrictions. Most states prohibit insurers from imposing any restrictions or exclusions on accelerated benefits that are not excluded or restricted in the life insurance policy as well. Likewise, most policies stipulate that the accelerated death benefit must be incontestable on the same, if not more favorable, basis as the base policy. Effective accelerated benefit on policy's death benefit. Accelerated life insurance benefits are typically limited to something less than the full death benefit. While 50% of the death benefit is a common limit, some policies provide up to 75%. There is no prohibition against insurers providing access to the full death benefit, though this is uncommon. Upon the insured's death, the insurer pays the remaining death benefit to the beneficiary. Some companies also deduct an interest charge from the death proceeds to compensate for interest lost due to the accelerated payment. Example: if accelerated benefits have been paid from a life insurance policy, the beneficiary is paid the net death benefit upon the insured's death. Elliot is the policy owner and insured of a $250,000 permanent life insurance policy. When diagnosed with terminal cancer, he exercised his policy's accelerated benefits provision by requesting and receiving $100,000, which was less than the maximum 50% permitted by the policy. He could use that money any way he chose. When Elliot died 18 months later, his beneficiary was paid a net death benefit of $150,000. In this example, the insurer did not deduct a charge for interest lost by paying out the accelerated benefit, though insurers are permitted to do so. Disclosure required. If a life policy includes an accelerated benefit provision, most states require that insurers provide a disclosure statement to the applicant at the time of application. If an accelerated benefit rider is requested after the policy has been issued, the disclosure statement must be provided to the policy owner at the time of the request. The disclosure must provide a brief description of accelerated benefits and definitions of conditions that will trigger payment of benefits. It must include an explanation of the effect that payment of the accelerated benefit would have on the policies. Cash value, death benefit, premium, policy loans. Some states require the disclosure to note that receipt of accelerated benefit payments may adversely affect the recipient's eligibility for Medicaid or other government benefits. Long-term care rider. A long-term care, LTC, rider lets policy owners tap into their permanent life insurance policy to help cover the costs of long-term medical care. Like the accelerated benefits provision, the LTC rider allows a portion of the policy's face amount to be paid out in qualifying circumstances. Unlike the accelerated benefits provision, the LTC benefit does not require the insured to suffer a terminal illness or catastrophic injury to qualify for accelerated benefits. LTC rider benefits become payable if the insured requires long-term care and meets certain conditions. Whereas the accelerated benefits provision is included at no charge in most policies today, the LTC benefit is available only as a rider that may require an additional premium. LTC rider benefits are similar to those of a long-term care insurance policy. Both provide money to pay for a range of medical and social service expenses at various levels of care, from nursing home care to home health care, adult day care, hospice care, and more. Qualifying for LTC benefits. LTC rider benefits become payable when the insured is diagnosed as chronically ill, for either a medical or cognitive, mental, reason. If for a medical reason, the insured must be physician certified as unable to perform at least 2 activities of daily living, ADLs, for at least 90 days. If for a cognitive reason, the insured must be physician certified, within the previous 12 months, that his or her health or safety would be at risk without supervision. Key point. Prior hospitalization is not required to qualify for LTC rider benefits. However, insurers may require an elimination or waiting period of 10 to 100 days before paying benefits. Effect of the LTC rider on the policy's death benefit. How a LTC rider impacts a policy's death benefit depends on which rider option the policy owner selects. Insurers offer 2 options. Integrated option. Like the accelerated benefits provision, this option draws LTC benefits from the life insurance policy's face amount. While policies vary, most permit up to 75% of the face amount to be distributed through an LTC rider. The beneficiary receives the net death benefit, i.e., face amount minus LTC payouts. This benefit may be included in the policy at no charge as part of the accelerated benefits provision. Generalized, or independent, option. Under this option, LTC rider benefits are separate from the life policy death benefit. Benefits paid to the insured do not affect the life policy's face amount. The beneficiary receives the full death benefit when the insured dies. This rider comes at a higher cost than the integrated option since it provides benefits in addition to the policy's death benefit. For your review. Accelerated benefits are made available either through a rider or as a provision of the policy itself. An accelerated benefits provision, or rider, allows a payout of some portion of the policy's death benefit while the insured is still living. The remainder is payable to the policy's beneficiary at the insured's death. With the LTC rider, benefits are payable if the insured requires long-term care for any reason. LTC riders typically come at a modest cost, whereas today's accelerated benefits provision is commonly provided at no charge. LTC rider benefits become payable when the insured is diagnosed as chronically ill, for either a medical or cognitive, mental health, reason. Prior hospitalization is not required to qualify for LTC rider benefits. Please pause the audio and watch the video.
Enticing, a life insurance policy may appear to someone with a terminal illness and needs the money now. Or similarly, imagine how valuable life insurance proceeds could be to someone facing the need for long-term nursing care. Fortunately, permanent life insurance provides what we generally call living benefits that allow a policy owner to access some portion of the cash value at any time for any purpose. But what if the policy owner needs more than the cash value? Well, life insurance policies today generally provide the opportunity to access some portion of the face amount while the insured is still alive. We call this a living benefits rider. Now make sure you understand the difference between a living benefit opportunity, which is available with every permanent life insurance policy, and a living benefit rider. Having a living benefit ability simply means the ability to borrow or withdraw from the cash value. That was discussed in a separate lesson. A living benefit rider is something different. It allows the policy owner to access a portion of the death benefit itself. And that is very much the distinction between the two. Again, a policy loan or withdrawal is limited to the size of the cash value, whereas an accelerated benefits rider, one of the two living benefit riders described in the lesson, actually allows access to a portion of the death benefit. Now, the two types of living benefit riders described in the lesson are the accelerated benefits rider that I just mentioned and a long-term care rider. What's the difference between the two? Well, the accelerated benefits rider really is something that once it's accessed, the money can be used for any purpose. Policy ownership remains with the insured, and if maintained, the remaining death benefit that is not distributed is payable to the beneficiary upon the death of the insured. The long-term care rider, same thing. Ownership remains with the insured, with the policy owner, but here the death need not be imminent, as it is the case with an accelerated benefits rider. And instead, with a long-term care rider, all that is necessary is that the person be deemed chronically ill, whether on a medical or cognitive basis, and needing long-term care. If that exists, then the policy proceeds can be paid out. And one last point, as you'll see in the lesson, there is a limit to the amount of the face amount that can be paid out. Depending on the company and the policy, it ranges from 50 to 80%. That's to protect everybody. It's also to protect the policy owner and even the beneficiary to provide the money that could be needed when the insured does die. So there are some limits to the ability to exercise the accelerated benefits rider, living benefit rider, but generally speaking, it does provide the opportunity to access more than the cash value.
Okay, everybody, here's the 4 questions from this lesson. Go ahead and like and subscribe if you like these kind of videos. We have a lot more lessons to go, and eventually health insurance will be coming up. Okay, so if you like these kind of videos, be sure to subscribe. All right, which statement regarding life insurance accelerated benefits is correct? Accelerated benefits are payable anytime the insured requires hospitalization. The insured must use these funds only for medical care. There is no cost in the form of additional premium in having the accelerated benefit rider. Accelerated benefit rider pays out part or all of the policy's face value while the insured is still living. Which is correct. I am going to say must use these funds for medical care, but it says you might be able to use them for other things, I think. I don't know, that's a tricky one. We should do some of these videos live in the future. That way I can get help on these questions. All right, from you, everybody in the audience. I might try that one time and see what happens. If you're interested in that kind of thing, be sure to comment and like, and then I know if I get enough people that say they're interested, then I will do it. If nobody answers me, then I'm not going to bother. All right, a long-term care rider on an insurance policy will pay benefits if the insured is diagnosed as chronically ill due to the following. A long-term care rider on a life insurance will pay benefits if the insured is diagnosed as chronically ill due to a catastrophic accident only. I'm thinking maybe a medical problem requiring hospitalization, but that's health insurance. It might be terminal. You have to remember that life insurance and health insurance are 2 different things. So any medical problem requiring hospitalization, you would use your health insurance, I would think. Under the integrated long-term care option, which % of the base policy can be used for a long-term care expense. Let's say 50. Using the integrated long-term care option, the beneficiary receives the remaining of the face amount as the death benefit of the insured death. In this way, the long-term care integrated option is similar to the long-term care integrated option is similar to term life. Could be a family rider. Either one of these. I'll put term for now. Let's see how we do. You answered 0% correct. Every single one I got wrong. Okay. This is the first time this has happened. I'm not surprised. Okay. Which of the following statements regarding life insurance benefits is correct? An accelerated benefit rider pays out all the policy's face value while the insured is still living. Wow, that's impressive. Okay. So that sounds like a good plan. Life insurance accelerated benefits. They will pay part of the policy's face value while the insured is living. Okay, this one here I wasn't sure. All right, so the long-term care rider on a life insurance policy will pay benefits if the insured is diagnosed as chronically ill due to a medical or cognitive mental health reason. Okay. That's all I got to say about that. The benefit is not available to insure with accidental non-fatal injuries. Okay, so it's up to 75% is what they cover, the percentage of the base policy's face amount. That was a total guess, so I didn't know. Couldn't remember. So the insured can use up to 75% of the face amount for long-term care expenses. So if they go in a nursing home or a senior citizen home, they can use up to 75% of that amount in long-term care. Under the integrated long-term care option, the beneficiary receives the amount of the death benefit as the insured. In this way, the long-term care integrated option is similar to an accelerated benefits rider. Okay, that was not going to be my guess at all. An accelerated benefits rider is what it is similar to. When the beneficiary receives the remainder of the face value as the death benefit. Okay. Term life benefit pays a death benefit when the insured dies. Okay. That's it. So, death benefit at the insured's death. In this way, the long-term care integrated option is similar to but the same thing. Term life pays a death benefit when the insured dies. The accelerated benefits rider the beneficiary receives the remainder of the face amount as the death benefit at the insured's death. So both of these things are when somebody dies, though. They have to die first before they get this. Okay, well, that's the end of this video. Thanks, everybody who stayed till the end. Appreciate ya.